Welcome back, guys. Today we're going to take a look at HP Incorporated. They are a computer manufacturer and they do printers as well. Over the past 5 years, they are up 42% and they pay a dividend of almost 4%. Um, they have underperformed the S&P 500, and Warren Buffett also has a stake in this company. So let's check it out today. They are a $27 billion company, pretty large company. Uh, their price to earnings ratio is 8, so that's a pretty low price to earnings ratio. That's good to see, usually. Let's take a look at their financials a little closer. And their revenue has been basically flat over the past 7 years. It's been up and down a little bit. So what I get from this is that this business is somewhat cyclical. And so sometimes it's down, sometimes it's up. Um, I would assume moving forward that it would be about flat, kind of like what they did in the last 7 years, maybe up and down a little bit. It does look like their gross margins did expand a little bit, so that is good to see as well. And yeah, their margins are okay. They're not very high, like 5 or 6%. And they bought back lots of stock over the past 7 years as well. And the way that I saw, at least, is they're buying back stock opportunistically. So that's usually a good sign. Their net debt is 8.52 billion, so we'll have to take that into account in our model. And cash flow, what are they doing with their cash? Well, they pay out a dividend, and they buy back lots of stock. So last year they didn't even buy back that much stock, but they bought back lots of stock in a couple years beforehand. And it looks like they just bought back some stock last quarter. Maybe they were paying off debt, or maybe they didn't see a good reason to buy back stock in the last 4 quarters. So yeah, it seems like they buy back stock opportunistically, maybe when the share price goes down. That's usually a good sign that management knows what they're doing. Their ROIC is actually really high. That's nice. Their gross margin around 20%, net margin 5 or 6%. And the analysts are thinking they're going to do 6% next year. Let's take a look at what they do. Well, they actually sell laptops and printers. So yeah, this is their future project products. Yeah, laptops, printers, they sell for business people and for regular consumers. And this is a breakdown of what they sell. So the personal systems, that's going to be their computers, 46% for commercial, 21% consumer, and then printing supplies and printing stuff is going to make up a large percentage of their income as well. And a little bit of a breakdown, their revenue's been going down. Yeah, we can see their year over year revenue is down 4%. It's possible that this is just cyclical. Um, it might not be a reflection on the business, but it could also be that this business is dying. Not quite sure. I don't think printing is really going away, but it probably is like somewhat going away because more and more things are going digital. Um, but they also have that large PC segment of their business. Yeah, revenue breakdown. Most of their customers are commercial, and usually commercial is better, except for consumer. Consumer printing is actually higher than their commercial, but commercial personal systems is a higher revenue. Let's take a look at what the analysts think. 3.43 going up to 3.63. This is probably due to buybacks. That's probably why their earnings per share is estimated to increase. And their revenue is supposed to be flat this year and then increase by 3%. They might be able to hit that. They might not. I would assume that they will be able to hit that. And then the revenue will probably be pretty flat. Let's look at their stats, see what their short percentage is. Short percentage of 2%. That's not that high, but it is higher than some other tech giants. So 2%, it's not too bad. Let's look at the model. So here's the model. I put their EPS estimate, revenue estimate here, buybacks, 1 billion in buybacks. They might do more. In net debt, I put that there, 8.5 billion. Discount rate of 10% because I want a 10% return on all of my stocks. Exit multiple 15. Right now they're trading at 9. Exit multiple 15. It's possible that we might want this a little bit lower just because this business is not growing at all. But 15 is already still pretty low, so I think that's fair. In terms of earnings growth, if we put their earnings growth at 2% a year, then their fair share price comes out to 45, and their fair share price after debts is 36, so that is much higher than their current price at 28, and that would make this company a buy. However, it is possible that their growth is not 2%, and this exit multiple might be a little bit high for this business. Taking a look at the revenue model, I have 0% growth. They're actually projecting 3% growth. So if we put that in, and then probably pretty flat from there. And 6% profit margins, I think they'll stay consistent with the 6% profit margin. Then we're looking at $41 a share with a fair share price after debt of 32. So I can see why Warren Buffett is buying this business or has bought this business because the valuation is pretty cheap. Maybe if an exit multiple of 12, yeah, even with an exit multiple of 12, this is still a buy. However, it's definitely possible that this business starts declining by a lot. So last year they were down like 3% in revenue. So what if we did like minus 3% for each year here in their revenue? Like it's a dying business and then maybe 0, 0 and an exit multiple of 12. Well, still the fair share price is around 32 after debts. Yeah, so like even if they're declining by 3% a year, this company is still not even bad. So yeah, the valuation is very attractive. Yeah, not quite sure if it's a good idea to buy a dying business like this, but it's also possible that it's just cyclical. So yeah, that's my thoughts on this, and I hope you guys liked the video. If you did, make sure to hit that like button, and I'll see you in the next one.